See here. So before break, we have completed probability distribution, probability analysis in capital budgeting. Those things are completed in the last class. Sensitivity we completed, and we also completed the concept called as a statistical analysis in capital budgeting. Next area we are going to start is risk adjusted discount rate. What is the concept name? Risk adjusted discount rate. Next one is the certainty equivalent. Last one is the scenario analysis. Scenario analysis is best case NPV, worst case NPV concept, small area. First, let us complete two problems on RADR as well as certainty equivalent. Let me first explain you the concept of what is this RADR approach, how this concept has come, logic behind, need. After that, we will start doing the problem. Very simple concept, not so complicated. See here. They say like this. Sales minus cost EBIT minus depreciation EBIT minus tax EAT plus depreciation cash flow. This is the cash flow of a particular project for a particular year. Okay, so listen carefully please. What they say is cash flow is made up of, I repeat, cash flow is made up of various items. Means cash flow will come because of sales, because of costs, because of tax saving on depreciation. What we have done here? Deducted tax saving. What we have done there? Deducted. What we have done here? Because of doing that, what benefit you are getting? Tax saving benefit you are getting. Okay. So sales, cost, tax savings on depreciation and taxation. Next one is the EAT. Like that, so many numbers will be there. We will add back depreciation and we will finally get the cash flows. They say this way. All these cash flows are not equally risky. Okay. All these cash flows are not equally risky. Example, PV factor. Which one? PV factor will be always return given for the risk taken. Correct or not? Return given for the, if you remember, yesterday's class we discussed about inflation or not? Answer. Except where inflation is clearly given in the question. In all the other questions we assume that inflation is not there. What is only there? Risk only is there. Correct? So even in this risk adjusted, which adjusted? Let me explain how to understand this model. What they say is, see here. Whenever we say a project cash flow is influenced by various factors like sales, cost, in that cost again, variable cost, fixed cost, like that, so many things will be there. Okay. All are not equally risky. What is risk? Risk is nothing but sir, in our syllabus called as a finance, I repeat, in our syllabus called as a finance, risk means what? Uncertainty a risk. Okay, that means a non-happening of a expected event. Everyone repeat. Is the risk. Repeat one more time. Non-happening of a expected event is called as what? Risk. Equity shares are riskier, not riskier. Stock market is riskier, not riskier. Risky. Equity shares are riskier, not riskier. Very risky. Are you understanding or not? Why they are risky? Because cash flows are not certain. Cash flows are not certain. Tell me, bank loan, bank deposit, risky, not risky? Why it is not risky? Interest return, whatever you get every year, is certain or uncertain? Certainty knocks the risk. Uncertainty pulls back the risk. So try to understand clearly. Always, when the cash flows are uncertain, when the project will be treated as risky project. When the cash flows are certain, project will be treated as risk free. Repeat one more time. When the project cash flows are, it is treated as risky project. When the project cash flows are certain, then they were treated as risk free projects. Clear everyone? Next. Again, project is risky. Project is what? Risky. But all the cash flows inside the project may not be subjected to same risk. May not be subjected to same risk. Why? Why they are not subjected to same risk? The reason behind that is, see here, depreciation is one of the element inside the cash flow or not? I mean, depreciation means, when I say depreciation is not there. Tax savings on depreciation is the inflow or not? Answer, yeah. Tax savings on depreciation is the inflow to the company or not? No, answer to the question. Depreciation amount, certain, uncertain? Answer, yeah. Asset cost, you know, you will purchase the asset. Definitely, what is the next year depreciation, you know? Answer. Next year depreciation, you know or don't know? Na? Answer. Sir, I purchased the asset, SLM depreciation, 5 years life, 1 lakh rupee asset, 5 years life. Tell me, what is the depreciation per annum? Answer. Next year, the next year, 4th year, 5th year, tax 30% here. Over a period of time, corporate taxes are around 30%. Correct or not? Sorry, optionally 22%, all those leave off. Normally, corporate taxation is how much rate? 30% rate. Okay? Now tell me, first year, what is my tax saving? 6,000. Second year, third year, fourth year, fifth year, certain, uncertain. Then how can you discount entire cash flow using the same discounting rate? Is the question started. Did you understand the point or not? Therefore, the people thought that we should not discount all the cash flows of a project using same discount rate. Risky cash flows can be discounted using a risk rate, but non-risky cash flows inside the project, you should not discount using a risky rate, you should discount using a risk-free rate. Listening or not, everyone? Tell me, depreciation is an inflow or outflow? No? Depreciation is an outflow, but really outflow will not be there. But it results in what inflow? Tax inflow. Simply tax savings we call. Correct or not, everyone? Answer. So depreciation gives tax saving or not? Certain, uncertain. Certain, uncertain. Sales minus. In that fixed cost will be there or not? Fixed cost is a cost which is fixed. Means constant or variable. Certain, uncertain. Then why you are taking the same risk rate? Third question. Salvage value, certain, uncertain. If there are two salvage value, unguaranteed, guaranteed salvage. First one, second one, guaranteed salvage. At the time you purchase, at that time only seller only will tell. We will only buy back from you after 5 years. Listening? Answer. Is there any example for that which can do like that? Not sale and lease back. I'm not asking about that. Really in sale. Do you know who will do like that? All luxurious car brands. BMW if you buy. Okay? If you buy BMW, at the time of purchase itself, they will give a schedule. 6 years after if you sell, this is a price counter will offer you. Do you understand the point or not? You use whatever number of kilometers you want. That engine has that capacity. Did you get the point or not? You use for how many number of years you want. That engine has that capacity. So, they will tell these many kilometers if your engine run and you are returning within a period of 3 years. This is a guaranteed price we will give you. Now tell me, my salvage value is guaranteed or unguaranteed? Answer, But a guaranteed means risky or not risky? Certain or uncertain? Then why you are discounting at the same rate again? Therefore, people were caught in a paradox. They got a doubt. Why we are discounting all inflows and outflows at the same rate? All certain cash flows should be discounted at a risk-free rate. Repeat what I said. Cash flows should be discounted at a risk-free rate. Next, all uncertain cash flows you should discount at a risky rate, or definitely to understand risk-free rate plus premium rate. Risk-free rate plus everyone, risk-free rate plus that premium you ask for the risk taken. Premium you ask for the. So now summarize everything and tell. In a project, all the cash flows are not equally risky. Some cash flows are having risk, some cash flows are not subjected to risk. Generally fixed costs, guaranteed salvage value, tax savings on depreciation, these are all fixed, which are certain and guarantee it will happen. Those are not having any risk in their occurrence. You should not discount them at the same rate at which you are discounting all the other cash flows in the project. Understanding the point or not? So this is the point he wanted to convey in the risk adjusted discount rate. But problems in the exam are coverage, whatever the institute is making is not so good. Simply to tell, they are not coining a nice question on this particular RADR. Okay, how they are asking is, they are asking student to do like this. They are giving a project information. Listening? They are giving a project information. They are asking student, all these inflows given are certain, do NPV calculation. All the cash flows given are uncertain, do the calculation they are telling. Now I am asking you, all cash flows given are certain, risky or risk free? PV at the rate of RF, PV at the rate of full K1. Answer. The first point. Listening everyone? If the all cash flows given are uncertain, then you should use RF other rate, which includes the premium. Did you now understand the concept clearly? This is the risk adjusted discount rate concept. On this, now we are going to do one problem. Don't expect these questions to come in exam. May come, may not come. Uncertainty is there. Okay. Damn sure I can tell some areas like that. I can't give guarantee for this because those are not so great. Only simple areas only. But let us write one small notes in this regard and then complete it. Are you understanding what I am writing there? Sales is risky or not risky? Risky. Therefore, we will use both risk free plus risk premium. Both we will ask on that. Next, second one. So do you understand the entire notes written on this? Completed? Shall we do a question on this? Questions are very simple. Again, I am telling you, chiller questions, because they can't bifurcate each and every cash flow and ask in exam. So therefore, what they are asking is, treat the project is risk free, apply risk free rate. Treat the project as risky, apply the total premium rate, calculate the discount rate and NPV. That's all, over. But still, there in the syllabus, if you do once, you'll have a clarity as to how to do. Shall we do the question now? What is the concept and what is the question we are going to solve? Risk adjusted discount rate. Up to question number 6 had we completed? See there. A 5 marks question. These are all 4 marks, 5 marks questions. Okay. Don't expect 8 marks or 9 marks or 10 marks from risk adjusted discounts. 4 marks and 5 marks. This is a 5 marks question already tested. An enterprise is investing rupees 100 lakhs in a project. Risk-free rate is 7%. Risk premium is 7%. Life of a project is 5 years. Following are the cash flows estimated. Estimated means certain, uncertain. Uncertain. Next, these are the cash flows. Calculate the NPV based on risk-free rate and also on the basis of risk-adjusted discount rate. Means only taking risk-free rate we will calculate NPV. Also considering the risk premium we will recalculate the NPV. Can we do it or not? First tell me what is the cost of the project. See there and tell. And what is the life of the project? Question is given on profits or cash flows. Therefore, you need not again add back any depreciation, nothing to be done. Directly we can start solving the answer. Shall we do it together? Okay. Keep the heading. Question number 7. Write down. Calculation of NPV, please. Cash flows are discounted at risk-free rate. Calculation of NPV if the cash flows are discounted at a risk-free rate. Okay. Write down. Year cash flow PV at the rate of, what is the risk-free rate? 7% PVCF. 25, 60, 75, 80, 65. Note down the numbers. 25, 60, 75, 80, 65. Rupees in lakhs. Tell the numbers once to me. 25, 60, 65. These are all the cash flows. 7% discount rate. Please tell the numbers once. 9, 935. 763. Multiply and tell the values. 23 point. Next. $61 point. 1 point. 335. First one also make it 23.38. One second. Now tell the value. 244.34 minus this. How much we invested? What is the NPV? $144.34. Tell me, this is risk adjusted cash flow na without risk adjustment. without risk adjustment. This is only RF, risk-free rate. If you discount, this is answer. But we want the answer as per risk rate. That is the second step. Right on. Step 2. Calculation of NPV at risk adjusted discount rate. Calculation of NPV at risk adjusted discount rate. Clearly below write down. In the given question, how much is the risk free? Risk premium. So total will be 14%. %. Rate. Can you please give me the answers? 8777. Next. First cash flow total. Last one 33.74. Total. So NPV equal to completed. So let us check the answers once. After that, you also get a clarity as to how to do. How many of you are still writing? Please complete fast. So NPV is 99.79. First one is the NPV under normal situations. Second one is the NPV if you adjust the risk. Okay. So this is the calculation that we have made. Shall we go to the next one? Before going into the certainty equivalent approach, check and tell whether these are right or not. First one we got 144. How much we got? 144.34 exact answer. And next we got 99.79. How much they got? 99.79. That's all. With this, we have completed another area called as risk adjusted discount rate. That is also completed. Everyone understood how to do the problem. Last one model is there. Claps are listening high. Then we completed decision tree. Even at the time of completing decision tree, you didn't get excited this much. I don't know whether chapter is getting completed. So okay, what is the next one? Certainty equivalent. Right also. Next concept is certainty equivalent approach. Keep the heading. Certainty equivalent approach. Certainty equivalent approach. Shall we start? Okay. See here. ரொம்ப easy concept again. Very easy. No difficulty. Nothing great. Small ideology. See here. I will show the question directly and I will explain so that you can understand much easily. Generally, what we will take whenever we are given with a cash flow, please listen, whenever we are given with a cash flow, we will discount them using a particular rate. Okay, using a particular rate. Why you will be given a return here? PV at the rate of 14%. Why you are giving a return? Return you are giving for the risk taken. Correct or not? Return you are giving for the risk taken. Okay. How you will do? Take a cash flow, hit it with the PV factor. PV factor will divide that particular thing and makes it invisible. Correct or not, everyone? Why you are dividing the return? For the risk taken by them. Correct. So for the risk taken, you will be paying them the return. Okay. Therefore, one concept came. See the screen. What they say is, first year, what is the cash inflow expected? Answer. This is certain or uncertain? Everyone. Okay. This is certain or uncertain? Uncertain. Why it is uncertain? Because it is happening today, in the past, in the future. I asked the management, did you do a project of this kind before? They said, sir, this project we have done around 30-40 times in our company history. Okay, that means you are having an experience as to what will happen in the project. Correct or not, everyone? Listening? Sir, if I run an academy for so many number of years, at least I can estimate how many students will come in the next batch. May not be exactly, for example, I can't tell 73, 85 like that. But at least if I guess 70, at least 65 will come. Or if I estimate 100, maybe nearing to that 100, 90, 92 or 105, 106 like that it will come. After experience of 20 years, if you estimate 100, 5 students should not come to the class. Listening or not? Sir, I am in CA industry, running for around 20-25 years. I have an experience to guess the market. Okay, I estimated that next batch for CA final or CMA final, as the case may be, I am expecting 100 students in the physical batch. Am I clear? As per the enrollments, as per the requests, everything came. I am estimating 100 students to physically come to the class. My estimate, if I make 100, maybe 80, 85 will come, or sometimes maybe more than that, 105, 110 may come. Correct or not? If I estimate 100, 10 students will not come. If I estimate 100, 500 will not come. Extreme, so they don't come. Even if they have to change, a small little amount of variation will be there, which is negligible for me. Listening or not, everyone? This concept is applicable for experienced projects. This logic is applicable for... Now listen. I said this way, okay? I started institute, some X. In that institute is there for a long period. That institute have given coaching for CA, CMA, CS, all levels they have given. Well experienced in the field of finance. In this particular area, they are well experienced. Listening? But they don't have money. They came to you. They said, please give us some money as a loan, or please give some money as an equity fund. We are opening one new project. For that new project, CA final, CMA final, as the case may be, we are opening a new project. For that, we have some capital expenditure. Listening? We are buying a new property to conduct, or we are taking a new property on lease. For that, huge capital expenditure is required. They are asking you money. Understood the point, everyone? They are asking you the money. They are one thing, they are having certainty. The certainty that they have is how many number of students are going to come. At least 95-100% they can tell it accurately. Clear, everyone? Enquiries are there. Fees paid students are there. Enquiries and requests are there. On the final day, some people will come. That estimate will be there. As per that, they are expecting 100 students physically will come to the final classes. Listening? Now they asked you, or you asked them, what is the certainty that definitely 100 students will come? They said, I am 90% certain. How much certain? Then you ask, how do you know? Experience. It's a commitment, yeah. We are having this CA journey since the last 20-25 years. I know what will happen in the tomorrow's day. Listening. Next batch, how many will come? I can predict today itself. Whether it will increase and decrease also, I will know. Clear? CA admissions are reducing. Automatically, what I will know? Automatically, the admissions in the institute also will be coming low. Correct or not? So, CMA admissions are coming down. When you see in 2020 how they are, during COVID time, copy batch is there. At that time, how the admissions, do you know that? Exams time, maybe you are not the luckiest fellows to get that premium benefit. Some premium users are there at that time. 2020 COVID time, they have conducted online exam. Home based exam they have. You know how beautifully they have written exam at that time. You wrote inter at that time? No. Foundation you wrote like that? Sorry. Home based examination was conducted. At that time, final people have passed like anything. So, like 10th class they passed out. Na? Huge percentage they also give. 60%, 56% something. 60, yeah? 60% something they have given. So now listen. Always, whenever there is a downfall, we can understand. When market is in a downtrend, no one will expect their business to be prosperous. Understood? When market is in boom, I can expect some prosperity in my business. Along with the market, I will also grow. Isn't it? So therefore, the summary of entire discussion is, see here, I went to the institute. I asked the management, management, you are asking us money for your new venture. Is it a new venture or experienced venture? I asked them. Sir, we are in this industry for past 25 years. We are the market leaders. We know everything. The knack of how to get the market, everything we know. We are not having a doubt on students, whether they will come or not. Our doubt is where to start. All buildings are full. Isn't it? So therefore they said that we are 100% certain, yeah, definitely minimum 100 students will come. Listening. Then I can also give finance to them. Okay, if 100 students come, from each student if you collect 50,000, 50,000 into 150 lakhs, you are asking me 10 lakhs, so easily you can repay me. So my money is at risk or not at risk? Like that investor will think. Okay? Listening. Therefore, experienced projects are involved. What projects? Experienced projects are involved. Management will not use PV factors normally. They don't use PV factors normally. Listen what they will do. I went to the management. I asked them, sir, how much money you are expecting in the next year? I will give money to you. You start your CA final batch, CMA final batch. You will collect the fees. How much fees you are expected to collect? Means how many students? Number of students into fees per student. What is sales? Number of units sold into sales price per unit. Likewise, what is fees? Number of students into fees per student. Listening or not? So tell me, sir, estimate the mental. They said 100 students might come into 50,000. We will definitely get how much? Answer, yeah, everyone. How much we will get? 50 lakhs, damn sure we will get, they said. So okay, sir, super, sir, I will give money, I said. Listening? Really, students came. As per their estimate, 100 students came. Academy will close with one batch, or it will continue? Answer. Next 5 years they estimated. How many years, sir? 5 years they estimated. First year they said 100 will come. Next 110 will come, next 150 will come, next 200 will come. Like that they said for next 5 years. Listening everyone. First they said how many students? Into 50,000. Total 50 lakhs. I asked them, is it really true? Really true na ante I can't tell 100% true. But with my experience I can tell 90% it will be certain. 90% it will be. When 90% it is certain, how much it is uncertain? Everyone. 50 lakhs or 10% is how much? Answer. That is the uncertain part. Then what is the certain part? 45 lakh. That is certain or uncertain? Certain is risky or not risky? Non-risky cash flow should be discounted what rate? That's what they will do here. So they will apply a certainty percentage. That depends on the management judgment and commitment. Listening? That's how this question is also framed. Understood? Study material, again and again I have been telling you, they didn't even make 1% attempt to explain what is certainty equivalent in a proper way. For experienced projects only these will apply. Did you get the point or not? Or how can you tell how much it will be certain? For example, here, this CA institute wanted to go into IAS coaching. Understood or not? They wanted to go into IAS coaching, bank exams coaching. There are so many other courses or not. They want to go for NEET. They want to go for other MBA courses, etc. Some other unrelated business they wanted to diverse. Can they give this certainty there? Answer. If you go to the management, ask them, next batch how many students you are expecting for CA final, CMA final, they can tell with maybe 5-10% difference may come, they can tell the number also. Correct or not? How come it is possible? Experience. Experience gives my ability to tell how much thing it will be certain. Understood the point or not? See the question now. Interpret the results. I sat with the management. I asked how much you are expecting in the next year. How much they said? Everyone answer 10 lakhs. I asked them, what extent you are certain on this? How much percent they are certain? How much they are uncertain? Therefore, take that much cash flow only which is certain. 50 lakhs has uncertainty. Sorry, 10 lakhs has uncertainty or not? 10 lakhs has uncertainty or not? How much percent of 10 lakhs is certain? Consider only that much as a cash flow. Don't consider entire 10 lakhs. Uncertainty you remove. Consider only, everyone, consider only. So, certain cash flow is 9 lakhs only. That certain cash flow means it will be risky or risk free? Apply risk free rate. That's why they give risk free rate here. Hopefully, you understood the concept clearly. Everyone in the class. Shall we start doing the problem now? Tell me what to do. Year, cash flow, certainty equivalent into cash flow. That will be certain cash flow. PV at the rate of RF, PVCF, NPV calculation. Can we do it together or not? Write down. Notes is required first. Certainty equivalent approach is a model where project cash flow, sir. What happened? Huh? Technical problem. So certainty equivalent is a model where the project cash flows are estimated in 2 ways. Namely, certain, uncertain. Uncertainty part will be removed. Uncertainty part will be removed by certainty equivalent factor, which is the judgment of management. So the cash flow obtained after applying the CE factor. What is CE factor? Certainty equivalent factor is a certain cash flow which is not subjected to any risk, and therefore RF is used. Certainty equivalent approach can be used only in case of completed. So let us start doing the problem now. But before going into that, see the completed up to here. By the time others write down, but answer one question. Certainty equivalent factor will be decided by whom? Management has to decide on the basis of the experience. Okay, but one point. Even if you go to the management, prediction of long future is very difficult than prediction of a short future. 1 year, next year what will happen? I can tell with a lot of certainty. 2 years after, how can I tell? Sir, till 2 years also I can tell. Maximum 3-4 years you can tell. Therefore, As the future is increasing, their ability to tell the certainty also will decrease or not. Therefore, certainty equivalent factor also will reduce. Understood? That's how they have analyzed this project. Did you understand how practical they are? So therefore, first 10, 15, 20, 25. Let us do the calculations now. What is the question number 8? Write down. Calculation of NPV using certainty equivalent approach. Write down. Year, cash flow, certainty equivalent cash flow, PV at the rate of 5%, and finally PVCF. Did you understand what we are going to do? Next, what is the life of the project they have given in the question? How many? 5 or 4? Cash flows 10, 15, 20, 25. Right now. Next, certainty equivalent factor 90, 85, 82 and 78. 90, 85. Rather than writing in points, for understanding sake, I am writing in percentage. Can you please interpret what is the percentage? They are how much percent certain that definitely 10 lakh will come. 90% they are certain. Means how much percent they are uncertain? For that uncertain, you don't consider in the project itself. Exclude from the project. Okay. How much I am expecting? How much I am expecting? 10 lakhs. No, it's wrong. Don't expect 10. Expect only 9 lakhs. That's all. That means in the project, consider a 9. Don't consider 10. But exclusion will be done randomly on the basis of certainty equivalent. As a year passes by, my guess will be decreasing. Percentage of accuracy of my guess will be decreasing. Tell me the answer now. Lakh? What? 75,000. These are certain or uncertain? Certain. Now certain cash flows are risky or not risky? Not risky. Therefore, risk again you should not reduce. Only risk-free return will be given for them. PV factors at 5. 0.952. 8. 3. Nine 6-0. 4,000. One second. Total? How much we spent on this project? 45 lakhs given in the question. So NPV is 5,35,035. Are you all comfortable with the calculations, everyone? Okay. What is the final answer? 5,35,035. See here. 5,34,570. That small difference will come because of the PV factors adjustment. Okay. That 100 rupees difference. That you ignore. Lakhs amounts, there will be a small difference, obviously. But everyone understood the concept clearly, yeah? With this, we have completed another approach as well. Along with the problem, certainty equivalent also completed. We are now left out with two concepts still. One is the base case NPV and adjusted NPV. What is the concept? Base case NPV, adjusted NPV. Also called as a Hiller's model, they call it. Okay. That alone, we are not even going to discuss now. Okay. Forex and international capital budgeting will come. Clear, everyone? At the time I will discuss that point. Okay. Without that, there is only one area we have to complete. That's called as scenario analysis. What is the concept? Scenario analysis. Last area. Keep the heading. Scenario analysis. So today where we started, yeah, exactly. What is the starting point for the today's class? Simulation that we started, right? So we started with simulation in capital budgeting. So there we started, first completed simulation. Next we came into the concept of which one? Sensitivity. One problem we have done on sensitivity. So sensitivity, a very big question, 10 marks question we have done, completed. Next we came to statistical analysis. In that we have seen the, sorry, sir, formula did you complete there? Here. Write down the formula. What is the formula? Write down. Standard deviation by expected cash flow. So we have done all these calculations. Next after that, we calculated the NPV at a certainty equivalent range. Next, RADR completed, certainty equivalent also completed. What is the last area for this chapter? Scenario analysis. What is this concept? Very easy again. Nothing great. Same with a small difference. Till now we have seen probability at three different economic situations. I told one question before the break. Economic status is very low. Do you remember or not? Very low, very high, or moderate, like that. Those are the scenarios. So there will be three different types of situations in scenario analysis. Worst case scenario, most likely scenario, best case scenario. Repeat. Most likely scenario, a best case scenario. There is one area called as a CPM and PERT. In the performance evaluation and review technique, there is one area, there also they use the same. TP plus TO plus 4TM divided by 6, same. Every time when something happens, some event which is uncertain, we will divide that into three parts in our mind. What can happen in best case? What can happen in worst case? What can happen if all are running on a likely basis? Listening or not, everyone? That's all. Nothing great here. Over. Cash flows also we will divide into three parts. Listening? See here. There is a project. Year 1. So please noise, please. Year 1. Best case, most likely, worst case. I will tell this way. If best case scenario occur, my cash flow will be 10,000. Moderate I will get 7,000. Worst case I will get only 3,000. Listening? Answer here, everyone. Year 2, year 3. Like this I will take information. Okay? I will calculate NPV in all the three cases. I will calculate NPV in means we will calculate best case NPV, most likely NPV, worst case NPV. All cases are NPV positive. Perfect. You can carry on with the project. Even in worst cases you will get profits. Listening. I calculated NPV. Best case positive NPV, little amount came. Moderate loss, I mean negative NPV. Worst case obviously negative NPV came. Rethink before you start that project. You understand how it will be useful? It will give a hint to the management. What will happen if the worst case arises after starting your project? Listening or not, everyone? Who expected that there will be a situation called as COVID pandemic? Yes or no, everyone? Anyone expected that there will be a pandemic that attacks the world? There will be lockdown. India will be shut down. We will sit at home, take plate and make sound. Who expected all these things to happen? Did anyone expected? No one expected. Now tell me, listen. If I start a project on Jan 2020, new project, estimating that it will grow leaps and bounds in next 2 years, what will be the situation? So what you have to understand, that project will survive, cannot survive. So who expects here what will happen in future? Future you can't expect. Therefore, management also thinks in the same way. What they will think? They think that whenever we are analyzing a project, we should analyze in three angles. Economy is good. Everything is good. Situations are bad. Understood the point or not? Paper came easy. Question paper came easy. Okay. Attempt is also postponed by another 1 month. All things are favorable. May exam ki June exam July. Postponement happened. Everything happened. But I didn't prepare. Now tell me, everything is okay. Worst case scenario, you couldn't prepare because you are attacked with COVID. Now tell me, can you do anything about this? Did you expect that you will be affected by COVID? Then, therefore, sir, you should not ask me one question now. Best case, most likely worst case. Sir, what is worst case that can happen? When they don't know, that only they call worst case. Am I clear? When everything is in my control, why I will make it to become worse? When something will become worse? When something is not in my hand, I can't do it, I can't handle it, it becomes worse. If something is in my hand, why I will make it worse? At least in terms of money. Are you understanding or not? Therefore, first point, tell me, all project cash flows are divided into how many types? Number 1, best case. Next one, most likely. Third one, worst case. Calculate NPV of all the three modes. In general, what they do is, if NPV is a positive in any two, go on with that project. If NPV is a negative in two, forget about that project first. Because always the best situations won't come in life. Are you understanding or not? You want something, other things will happen. Then how can you tell? I want cash flow. I want a very big NPV. But why it will happen? Best case will never happen, yeah. Understood? So therefore, don't take up the project at all. Like this, we need to give a judgment on this particular concept. Everyone understood the point clearly, yeah? Small concept. Let us do one problem and close this. Okay? I will show you one question. Try it. At least try to interpret it. Even if you don't do, no problem. But to try to interpret that properly. Yes, this one. A 4 marks question. XYZ Limited. Read. XYZ Limited is considering a project A with initial outlay of 14 lakhs and possible 3 cash inflows attached with the project are as follows. Tell me. Year 1. Which year? Year. Worst case, how much will come? Most likely. Best case. Now tell me. Can I calculate NPV of all these scenarios? How many scenarios are there? First one, second one, third case. We can calculate NPV or not? Next, read. Assuming cost of capital is 9%, determine NPV in each scenario. If XYZ Limited is certain about most likely in the first 2 years, but uncertain about third year's cash flow, analyze what will be the NPV, expecting worst case scenario in the third year. Very good question he asked in exam. That's why 4 marks it was given, or else 1 mark also more. At least they gave 4 marks for the second bit they have given that. Remaining bit is just doing one NPV calculation. Will we do it together? Before that, tell me, what is scenario analysis? What is scenario analysis? Making a optimistic, most likely, and a pessimistic analysis of a project. Everyone tell me. Optimistic, most likely, pessimistic analysis of a project means always you should not assume and estimate one set of cash flows and move on with the project. You should also see the other way around. If worst case comes, you can't do anything. Situation is out of your hand. Even in the case how to tackle, if you understand at the beginning of the project, even if a worst likely event occurs, you will be safe. Or you estimated worst case and most likely. In both the cases, negative NPV is coming. What does it mean? You will survive only if best case occurs as per your estimate. Best case will happen always. Then don't take up the project. At least your NPV should be positive in 2. Understood the point or not, everyone? To accept the project. Shall we start doing it? Okay. Problem we can do. First write down notes. Scenario analysis is a scenario analysis is a technique used by the management. Scenario analysis is a technique used by the management to analyze the optimistic, most likely, pessimistic outcomes from a project. Scenario analysis is a technique used by the management to analyze the optimistic, most likely, and pessimistic outcomes from a project. Therefore, the total project cash inflows segregated into three parts and NPVs are calculated. If NPV of any two cases is positive, we can accept the project. Shall we? Let us start one question and complete this scenario analysis question as well. Take this question. First, remember what is the outflow of the project? What is the inflow? What is the inflow? One case, three cases we have to do. Three cases we have to do. What we need to calculate? NPV. What we have to calculate? NPV. Can we calculate it together? First tell me, for all the three cases, cost of capital is same. What is the cost of capital? Can we do for all the NPVs together now? Let us do. Question bank, question number 10. Let us start. Write down. Year. Year. PV. PV at the rate of how much percent they have given? 9. First write down this. No noise please. How many years we are taking? Tell me the PV. 9% की PV calculation. Point. Next. Seven. These are the PV factors. This is same for not 3 years. This is same for all the three scenarios. What is the first scenario? Worst case. Best case. Tell me. Cash flow, PVCF. Cash flow, PVCF. Cash flow, PVCF. They are given in thousands. So directly write down like this. Tell me worst case scenario 450, 400 and 700. Write down. Four hundred fifty, 400, 700, 550, 450, 800. Next. So 550, 450, 800, 650, 500, 900. Hey, who is that fellow? Yeah, shouting. I know. Outside the class, love is studying. Sir, okay. I thought that that's something related to election campaigning, product campaigning. 650, 500, 900. Tell me the PVCF value. Next. 336.8. 5. So all these rupees are in thousands. Next, second, 550 into 0.917. Huh? 504.35. Next, 378.99. Okay. 6. Let him go. We'll start the class. Let him sell his product first. Next, last one. 650 into 0.917. 596.05. 460. Next. 0.8. One two 89.85. 1000. 17. 1753.95. Disco in all the cases is 1400. NPV will be first case 110 point. Negative or positive? Negative. Next one 270. 100.85. So majority two cases information given has resulted in a positive NPV or not. So you may accept the project. This is step 1. Conclusion right now. The company may accept the project. Since NPV is positive in 2 out of 3 scenarios. Completed. Next. This is not the only step. There is another step that was asked. Let us also complete and close. See the question. Sir, we are expecting how many scenarios? Answer. But how beautifully they frame the question, see that. If XYZ Limited is certain about most likely in year 1 and year 2, most likely in year 1 and, but uncertain about the third. Okay, third year what should apply? Worst case is expected. Means what? 700. If 2 years most likely, last year worst case come, what will happen? He is asking. Can we do it or not? Right now. Calculation of NPV in a, sir, this is most likely a worst case a combination a, that's called as a hybrid scenarios. Yep. First situation what we are going to analyze. Most likely. Third, tell the cash flows. 1 minute, 1 minute. These cash flows are rupees in thousands. Okay. Now tell the answer. What are the cash flows? 550. You are talking about most likely 550, 450. PV at the rate of 9. 9% already you have written a point. First one is 0.35, 3, 9. Total, huh? How much? 1423. 23.65. 23.65 thousands. So acceptable, not acceptable? Write down. Completed writing up to here, everyone? Completed. With this, we completed capital budgeting fully. Okay. So long back we started. Around 30 hours we spent on this now. Maybe including the today's lecture, maybe it crossed around 30 hours. 30 hours we spent on this particular area called as capital budgeting. Okay. So this is the importance of this chapter called as capital budgeting. Next area we are going to start is much more Thambola area called as Forex. After Forex, next we start with the area called as derivatives. Mind blasting concepts will come one after another. So first we will complete difficult areas now, then we will go into simple ones. Up to here everyone had a clarity? Okay, done. So we have now completed capital budgeting as an area. So concept wise everything is completed. Just we need to do some additional workings, that's all. That is only for practice purposes. If you do more problem, more practice will happen. Understood? Okay. Anyway I shared them the question bank also. You will get it. But they will give in their format, I think. So in that anyway questions will be there. You can strictly put it and solve it and complete the answers as well. Okay. So with this we have completed the chapter capital budgeting and we are going to start with a new area. Keep the heading in your notes. International financial management. You can take break, don't cry. Heading I said. Keep the heading International Financial Management. Sir, in your book, 2 chapters they divided. Forex, okay, and other risk exposure, like that, with the different names they have spread. For example, if there are 50 questions, 15, 20 questions they given one chapter, 30 topics they have given in another. I don't want it to do like that, like what our ICAI, all these people are doing. Let us put all Forex related questions in one set. I call it as International Financial Management. In this International Financial Management, I will include International Forex Management, International Forex Risk Management and Exposure Management, International Cash Management, International Working Capital Management, International Treasury Management, International Capital Budgeting. Everything I included into this, except one area called as Currency Options and Currency Futures. Repeat, what is it? Options. A reason you should understand that can't be understood unless options and futures are completed. Except that one slot, everything we will cover related Forex in this Forex area. 70 problems are there. We will do all the 70 problems in the class. My word. When we say, definitely, when I say that we will do all the questions in the class related to Forex. We will not leave anything. Every question we will do in the class. Clear? So this is the situation. So we are going to start off with our area called as International Financial Management. First 15 questions basics. Basics mean those also tested in exam, but those are basic to understand the chapter called as Forex. So once that is completed, then we go into the problematic part. Simply to tell, listen, if you get absent to this session in the evening, I mean after this, generally no one will do, but precautionarily I am telling. Okay, like a word of caution like that you can take. If your mind is absent though you are present, or you yourself is not present, from tomorrow you need not come till this chapter is completed. Reason is you will cry. Why? All others will be answering. మనం అలా కూర్చొని ఉంటాం. So therefore those who are absent for the today's class, 2 minutes silence. Other than that I can't do anything. Because basics, if you don't listen to Forex, serious, sir, never I joked about importance difficulty levels. Same I am telling. IFM introduction, if they miss, they need not attend to the next 3 classes. 3 Forex is completed. 3 days, daily 9 hours, 27 hours, they need not come to the class. Happily they can sit, because they can't understand what is happening in the chapter at all. Yeah? So, take a break and come. We'll start with a new area called as International Financial Management. How many marks will come in exam again? 20.